Hello, and welcome to Taxes in 10, where we take a tax topic and break it down in about 10 minutes. My name is Mark Barnes, and I'm the managing partner of Copper Canyon Tax and Accounting Services in Tucson, Arizona. We are a boutique firm that specializes in small business accounting and taxation. This episode is on gift tax. First off, what is a gift tax? Gift tax is a federal tax applied to an individual giving anything of value to another person. Gifts can be made in cash, personal property, real property, stocks, or other investments. For something to be considered a gift, the receiving party cannot pay full value for the gift. If they pay an amount less than its full value, the difference between the fair market value and the price paid is considered a gift. Remember, fair market value is what a willing buyer and a willing seller agree upon. I recently had a client sell their rental home to their son. The house has a fair market value of $220,000, but the sales price was $100,000. The $120,000 difference is considered a gift. What is not considered a gift? Gifts to your spouse. So when you buy your spouse that Mercedes-Benz E-Class Cabriolet, that isn't a taxable gift. Gifts to political organizations are excluded. If you pay medical or educational expenses directly to a medical provider or to the educational facility, they are excluded. Charitable gifts are excluded. Support for your minor child, even if required by a divorce decree. And gifts that do not exceed the annual gift limit. On December 31st at midnight, the clock resets on your gift-giving ability. Let's take a look at a scenario. Jack gives his son Randy a gift of $10,000. Also, during the year, he pays Randy's $7,000 college tuition by writing a check directly to the college. In fall, Randy gets injured and Jack writes a $5,000 check directly to the emergency room. Two of these items are not considered gifts, since the remaining $10,000 is below the annual gift-giving limit. No gift tax return is required. Gift taxes are reported on Form 709, the United States Gift and Generation Skipping Transfer. Form 709 must be filed if a taxpayer gives a gift that exceeds the annual gift limit, a taxpayer is making an election to split the gift, or a taxpayer makes a gift of a future interest. Typically, when Form 709 is filed, the lifetime exclusion amount is reduced rather than taxes being paid on the gift. What is gift splitting? Gift splitting is an opportunity, when done correctly, to double or quadruple your annual gift-giving ability. In order to properly execute, a tax election needs to be made specifying the transactions are being split. Let's take a look at our scenario. Jack and his wife Diane agree to split their gifts. Jack gives his son $30,000, and Diane gives her daughter-in-law $30,000. Each gift is more than the annual exclusion amount, but they can make them non-taxable gifts by splitting them. Each spouse must file a gift tax return indicating that the gifts are split, which results in each gift being below the annual exclusion limit and thereby not reducing their annual lifetime limit. Here is Form 709 for Jack and Diane taxpayer. Line 10 asks for the number of donees, which in this case is 2. Line 11 is asking if the taxpayer has ever filed Form 709 before. Line 12 is asking if the taxpayer is making an election to split the gifts. In this scenario, the answer is yes. Line 13 and 14 ask for the consenting spouse's information, and line 18 requires a signature of the consenting spouse when there is a gift split. Let's hop over to Schedule A. Part 1, Item 1, is our first donee, Ralphie taxpayer, the son. Item 2 is Jack's portion of Diane's gift made to Sophie, the daughter-in-law. Remember, Jack gave $30,000 to Ralphie, and Diane gave $30,000 to Sophie, and they are each electing to split the gifts. Column D is the adjusted basis of the gift. Since this is cash, it is face value. Column E is the date of the gift. Column G is where we allocate the split. And column H is the taxpayer's net transfer amount. Let's jump over to Part 4 now. Line 1 is our total gifts from Schedule A, column H. Line 2 is where we apply the annual gift limit exclusion. This is a 2020 form, and for that year, the gift limit was $15,000 per person. Line 3 is line 1 minus line 2, which results in the taxable amount. In this case, 0. Now let's jump back to page 1, part 2. Line 1 is the taxable amount, which we have already determined to be 0. And line 7 is our lifetime exclusion. Remember, both consenting spouses must file a gift tax return, and both must sign the other's return on line 18. How about present interest versus a future interest? A gift of present interest is one that the recipient is free to use, enjoy, and benefit from immediately, no strings attached. A future interest gift happens when the recipient doesn't have complete use and enjoyment of it until some point in the future. Common examples of future interest gifts are reserving a life estate in real estate or funding a trust. In either case, your beneficiary typically doesn't become a full invested owner until your death. Let's talk about the basis of gifted property. Gifts of property retain a split basis. For purposes of determining gain or loss on the disposition of the gifted property, a taxpayer must consider the following: the adjusted basis of the gifted property at the time the gift was made, the fair market value of the gifted property at the time the gift was made, and any gift tax actually paid at the time that the gift was given. When the taxpayer sells the property that they received as a gift, they calculate the gain based on the donor's adjusted basis plus any gift tax paid. If the property is sold at a loss, the taxpayer's basis is the lower of the donor's adjusted basis or the fair market value at the time of the gift. As I'm preparing this, I received an email from a client. Condominium was purchased for $80,000. The current fair market value is $120,000, and they want to sell it to their daughter for $60,000. Step 1, determine the gift amount. We have the fair market value of $120,000 minus the sales price of $60,000 equals a $60,000 gift. Step 2, determine if a gift tax return needs to be filed and if gift tax needs to be paid. Yes, the return needs to be filed for 2 reasons. 1, we are gift splitting, which automatically makes a requirement to file. But if we weren't, the gift exceeds the annual gift limit, so we would be required to file for that reason. No tax will be paid, as we will elect to reduce their lifetime exclusion. And then step 3, determine their carry forward amounts for basis. The donor's adjusted basis is $80,000, and the property's fair market value is $120,000. If the property is sold at a gain, the gain will be calculated based on the sales price and the donor's adjusted basis of $80,000. If the property was sold at a loss, the loss would be calculated based on the lower of the taxpayer's adjusted basis or the fair market value. In this case, the adjusted basis is lower and would be $80,000. Here's some interesting tidbits from the Internal Revenue Code. If the donor dies before paying the tax, the executor or administrator of the donor's estate is responsible for paying the gift tax from the estate. This is in Treasury Reg 25.2502-2. And in Code Section 6324, Special Liens for Estates and Gift Tax, unless the gift tax is paid or becomes uncollectible due to the statute of limitations, which is 10 years in this case, such tax shall be a lien upon all gifts made. If the tax is not paid when due, the donee of any gift shall be personally liable for the tax to the extent of the value of the gift. Make sure to hit the subscribe button to keep up to date on all of our Taxes in 10 video series, and give us a like on Facebook at facebook.com/potentialcpe and on Instagram at instagram.com/potentialcpe. If you are interested in earning continuing education on this topic, please visit potentialcpe.com for a list of all the courses we provide. Our 1, 2, and 4-hour on-demand webinars will focus approximately 75% of each hour educating theory and regulation, and 25% of each hour on procedures with real-life examples, where we walk you through completing the necessary forms to increase your potential.